Hey everybody, today on the Value Evil podcast, we're joined by David Bastian of Kingdom Capital. David is an original attendee of the Value Evil conference, and we're very excited to have him deconstruct an idea in real time. I'm always impressed by David's depth of work, which is on full display today, his conviction, and his willingness to think out loud in the public sphere as a feedback loop for better decision making. I've been fortunate to have deep conversations with David about his process, his ideas, one of which we'll be discussing today. Today, we diligence Magnera, a non-wovens materials business. It's a result of a spin-off for the Special Sits vans and a reverse merger. David believes, although highly levered, it to be misunderstood, and will explain why capital cycles, capacity rationalization, and disciplined operators can create asymmetric value, and patient investors can capitalize. So please enjoy the Value Evil podcast with David Bastian.
The information provided in this podcast is for educational and informational purposes only and should not be construed as investment advice. We are not financial advisors, and nothing discussed on this podcast should be considered a recommendation to buy, sell, or hold any security. All opinions expressed are those of the hosts and guests and are subject to change without notice. Listeners should do their own research and consult with a qualified financial advisor before making any investment decisions. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results.
All right. Hello, everybody. Welcome to the Value Evil podcast. I'm your host, Jeff Hendrickson, here with my co-host, Donnie Sitar, back from the holidays, Donnie. I don't know about you.
We're back.
You're in Minneapolis. I'm down here in Ocala, Florida for 2 months. You know, after this, I'm going to go out, work on my tan. It's great, man. How you been? How you been, Chief?
Well, we're going to be hitting the negatives this weekend, so it'll be a little bit opposite the temperature-wise. Gives me more time to scroll away in a warm room here and focus. So I won't discuss what's going on in the outside world right now, but I'll keep it at that it's good to stay home and it's good to have interesting people to talk to and good to have a very exciting podcast guest today.
Yeah, well, we've got David Bastian. David is attendee to our Value Evil conference in Charlottesville. I believe, David, you're coming back this May. We're getting the finalizing everything there now. And David, before we start, I know we got a very interesting idea to talk about, but just go ahead and maybe take a couple minutes, introduce yourself, your background, your investment philosophy, and then we'll dig into this idea a little bit more.
Sure. Thanks, Jeff and Donnie, for having me on. Yeah, so I've been running Kingdom Capital here for about 4 years this month. So as you mentioned, I was the inaugural attendee at Value Evil and really enjoyed getting to know the guys there and like the banter and the opportunity to discuss new ideas. So I love that you guys are doing the podcast now. But yeah, so Kingdom Capital, we've been doing this for 4 years. I come from somewhat of a non-traditional portfolio manager background. I didn't work at a fund prior to this. So Kingdom Capital was my only real track record in the public markets. Prior to Kingdom, I was working in mergers and acquisitions, due diligence. So worked on a lot of private equity deals and kind of saw how some of the big names in that space would value companies and was using that on the side to try and get better at valuing small cap stocks and making money that way. So I have a bit of a deep value special situations persuasion. So it's been a rough time frame to try and do that over trying to beat the tech and AI momentum in the market. But we've had a good 4 years and it's been a lot of fun. So this is definitely on the non-hot space type of idea that we're going to be going at today. But I
guess it depends, right? Look, I'm a big believer in AI and love researching the space, but nothing gets me more fired up, to be honest, than the baby diaper value chain, which is what we're going to be talking about today. Okay, so I'm going to do a quick intro of my understanding of this company because I actually have a little bit of history with it, not as much as you do. And then I'm going to turn it over to you and let us kind of start fleshing out the thesis. But the company that we're going to be talking about today is Magnera. Now, I know Magnera because part of that company, it was formed in 2024, I believe. It was a merger. It was a reverse Morris Trust transaction, something like that. I'd have to Google what that is. But if that's relevant, please explain the dynamics there. But it part of the majority of the company comes from Berry Global's a division of Berry Global that specializes in, well, the whole company specializes in advanced material solutions around fabrics, right? So non-woven fabrics. So we'll talk a little bit later about air-laid versus spun-bound and these different technologies, but it's fabrics that go into everything from, as I said, baby diapers, coffee filters, tea bags, disinfectant wipes, healthcare PPE, so like masks and gowns and all this stuff. We'll talk more about the products, but I'm familiar with this company because it was a merger between a division of Global Berry and another company called Glatfelter. Now, I'm familiar with Glatfelter because I used to run a quantitative value strategy that owned, 150 different positions at any one time that were, for lack of a better word, being, showing some types of price dislocation. And Glatfelter was one of the companies we owned. And, obviously, if you own 150 companies, you're not, it's a quant strategy. You're not digging into these companies in great depth. But I know that Glatfelters, they did a very questionable acquisition, or a couple of them, I believe, kind of during the pandemic. One of which, or two of which, were specifically focused, I believe, on spunbound tech that had a big market share or was highly dependent on healthcare PP&E. So you had this classic peak on peak setup, right? They're at a peak revenue and they're paying a peak multiple at a time when the world thought, the pandemic's never going to end. It's the new normal. We want exposure to the space. And then lo and behold, the pandemic did end. And, I think volumes in those businesses, fell off probably a lot, but they financed, and correct me if I'm wrong, I think they financed those acquisitions with a fair amount of debt. So you had a peak on peak setup, bad capital allocation, bad acquisition, bad timing. Unfortunately, a very, a story that happens way too often in public markets. So Glatfelter stock had performed very, very poorly because of this.
Yes.
And, my understanding is that, essentially it very well might have gone to zero had this transaction not happened. But they did combine these companies. I think the Glatfelter shareholders got like 10% of the combined total, and maybe the Berry Global got like the 90. But anyway, so they put this business together. I think the old team at Glatfelter's gone, so bad capital allocation's hopefully gone, and now you're going to combine these two companies that have complementary technologies in the nonwoven space, is my understanding. But I'm going to stop there and let you go into detail. That's kind of the setup, right? That's my understanding at a high level. But please dig into it. Let us know, why you like it, and we'll just take it from there if that works.
Yeah. So like you said, this was a product of some missteps for the businesses. I think you can kind of look a little bit more at the rationale for kind of how each company ended up here and why this combination made sense. But yeah, basically Glatfelter got over their skis on leverage on some acquisitions. They paid multiples that, again, peak multiples on peak earnings, between 8 and 12 times for some businesses that proceeded to then earn a lot less money. Glatfelter got additional headwind, which was they had a pretty significant earnings stream from their facility in Dresden, Germany, that was selling wall coverings into Ukraine. And so the Ukraine Russia war happened right around the same time that they had paid up for these acquisitions and increased their leverage. That there already was a lot of leverage there, and then they had that happen, which an unfortunate break for their business, and took what was an otherwise profitable facility to break even or even operating at a loss. I think they went from like 90 to 50% utilization in there. So absolutely not the kind of headwinds you needed. Also, their European manufacturing base would work with a lot more of floating costs on their energy and production, which again, 2022 was not a great year to have floating energy costs in Europe.
No.
So you had a lot of different pressures on the business that weren't unique for a European manufacturing business that were happening there right after they had paid up for these businesses as those earnings were declining. But it wasn't all bad. One of the assets that Glatfelter brought over with the merger was that they had fixed sub 5% debt they had taken on with these acquisitions, and they were able to bring that into the combined capital structure. So they had a cost of capital that would not have been replaceable when this merger came about, but it was something that they were able to bring into the structure that, now Magnera has debt that they're paying a very low coupon on and isn't due till 2029. So this wasn't all bad, but there were some things there, and there were some really good assets in technology in Glatfelter that basically once they got over their skis, they weren't really able to invest in those in a way that really maximized their value. So it wasn't that this was a bad company. It was just it was a company with a bad capital structure, or at least a bad, over leveraged structure that wasn't going to allow them to run it well in the public market. So, the Magnera team saw the value in that. They came up with this reverse Morris Trust transaction structure where basically the legacy Berry got a dividend out of the health and business that they were spinning into Magnera, and they raised a lot of debt to fund that. Combine that with Glatfelter, 90% of the shares went to Berry shareholders, and then Glatfelter kept the remaining 10%. So it was it was structured to give everybody involved some equity value, give Berry an opportunity to, as it turned out, sell their business to Amcor shortly thereafter, with it being more of a pure play packaging solution. There was a lot of things going on in the background here. There was, the HH&S business at Berry had divested some things leading up to this. These are, very, very new businesses being brought together under the legacy HH&S management team. So yeah, that was kind of how we got to where we are today. Berry was looking to sell to Amcor. This wasn't a part of that business. Glatfelter capital structure was broken and they needed to find a partner. And so the thesis was, hey, we can put these together. We've got 4 and 6 years of term on our debt. It's relatively low cost. We were able to, they were able to upsize their offering that they did when they first went to market with this thing about 14 months ago. So they were able to raise a lot of cash. They had a lot of investor interest in this, and yeah, they were able to get some momentum to go do that. What hasn't worked since then, and if you go back about a year ago, they came out in February, first earnings report as a company, laid out guidance that was roughly in line with kind of what everyone was expecting when they first announced this merger. And insiders came out in the market. They were buying stock in the north of $20 a share, and kind of just, it's like, all right, we're here, we're building some momentum. This business is good to go. And then tariffs hit. My initial understanding was that tariffs were going to be broadly neutral to slightly positive for this business. And it has been for the majority of the business. The European business is doing all right. The US business is doing well, but their otherwise very profitable South American business got run over by supply coming out of Asia being redirected from North America into South America, and really, really nerfed a lot of their profitability there. So that was where the stumble came in. We came out, things were looking good. Right. And then that was kind of the point of, both these businesses had kind of seemed like they were bottoming end of 24 into 25. And then the Americas segment got hit from the tariff noise. So they still feel good about that business. It's something that I would view as temporary. Certainly wasn't what everyone was looking for, is it? And so the stock has just spent the last year mostly melting from the tariff impacts. Fast forward to November, they came out and guided for the next fiscal year. Business is now suggesting, hey, we are going to start turning this around again. Stock's since recovered some, but yeah, overall, the background here has been, started a merger with momentum, got kneecapped, and now we're trying to figure out, like, is this business broken? Is it okay? What exactly is the potential here, and why, why did this not work out as well as everyone thought when they first bought into the story a year ago?
Do you want to let's just lay out what exactly they do? Like, just if you've never heard of this company, it is Advanced Material Solutions. So when I say that, I think non-woven, I believe that they say fabrics, right? That go into a variety of products. Maybe let's talk about the products they go into, the end markets, how cyclical or maybe not cyclical those end markets are, kind of, given the fact that we have to support a lot of debt service. But yeah, maybe just kind of broad picture of what the company does and the customers they serve, et cetera.
Yeah, there's a few different technologies that they're using and the kind of under this non-woven umbrella. There's not a whole lot of other comparable public companies to this, so the technology may not be super familiar to a lot of people. But basically, you're just doing very high volume of a lot of kind of personal care and home applications. You mentioned the PP&E, they're in that. They'll do furniture coverings. They'll do. Last call, they mentioned that they're doing like liners for the inside of automotive vehicles that are kind of soundproofing. Very markets though is stuff like diapers and hygiene, wipes, anything that's kind of in that material category. I mean, over 20% of the business is wipes and diapers each. So a lot of that is happening there. I mean, they're in house wraps, like the Tyvek wrap that goes around your house. Like that's something that Magnera is putting together. A wide variety of applications. They're in your K-cups, they're in your pods. The technology is widely applied to different types of absorbent and, again, non-woven materials. It's what appears to be a rather commoditized space. We can get into that a little bit more. Some of this is kind of high volume, low specialization, and some of it's not.
And they make the materials. They don't make baby diapers, right? They make the materials that go into baby diapers. So their customers would be like Procter and Gamble, as an example, correct?
Yeah, end markets are Kimberly-Clark, Procter and Gamble, Clorox. Like you go follow a lot of the big consumer staples companies. That's who's buying from them.
Yeah, David, a lot of these markets or products that you're mentioning, they seem fairly secular, but there is this, I guess, cyclical story that's been taking place since COVID. Maybe just explain the dynamic of, why there is such an oversupply, why it continues to overhang, and then I think understanding the Chinese, low-cost Chinese competitors, like how they fit into this mix, because it sounds like there is a dynamic here that's uncertain about where it's going to go in the next few years with the Chinese competitors.
Sure. So it is, broadly speaking, this is a market that's fairly localized. Like if you think about if you're manufacturing wipes, there's a lot of moisture in those. They're pretty heavy. They're compact. Like if you have a whole trailer of wipes and you put that on a boat and you ship it across the ocean, then you put it on a truck and you ship it to, and like all the stages that are going between the initial production and the amount of weight, it's not a particularly efficient product to ship all over the globe. So in
You don't want
Magnera's
to ship
case,
water.
most of
You
their
definitely you want to ship it dry. Yeah, right. Is what
yeah.
you're saying, and then yeah.
Yeah, so a lot of these products don't move particularly well. They're compact, they can be heavy enough, and again, the margins on these aren't so great that you really want to spend a lot of time shipping them all over the place. So while there has certainly been manufacturing of some of the products in Asia that are being shipped to the US and some low-cost competition, the primary manufacturing, like Magnera's footprint, if you look at where their manufacturing is versus where their sales are, it's basically 1-to-1. It's about 2/3 of their footprint is in the Americas, about 20 or 30% in Europe, and the last 10% in Asia. And their sales are almost exactly the same percentages. So for the most part, what's manufactured in America is sold in America. What's manufactured in Asia is sold in Asia. What's manufactured in Europe is sold in Europe. They're not doing a whole lot of shipping stuff cross border, which is again part of why when I was looking at this as a tariff beneficiary, it seemed like, well, for the most part, the inputs and the outputs are all staying in country. They should be doing a decent job being protected. And to the extent that there is supply coming in from lower cost competition, then they would be protected. So yeah, that's the roughly that's where the product's going. But yeah, they trying to remember what else you asked here.
Overcapacity. So really, this is the
Yes.
what we're saying is we're going to rationalize the overcapacity over the next 2 to 3 years. And
Sure.
this company is going to be a beneficiary of it. And you have a really good. I think you're going to get into the operators here, but I'm just
Yeah.
trying to understand why the hell there's such an overcapacity in 2026. We're still talking about it. It seems like we should be worked through that by now.
Yeah. So these lines are really big. Like if you want to go put in a non-woven line, like you can call up Magnera's CEO and ask him like, hey, what's it going to cost you to put a non-woven line in Asia right now? And he'll tell you that it's hundreds of millions of dollars to build the facility, to buy the equipment, and to build the inventory to start this up. I think I've heard as high as $400 million to put in a line that's going to do $100 million of revenue a year. So I think you could probably cut some corners, or if you're building it on a site where you already had some capacity and you're kind of is more brownfield rather than like a greenfield line, you could probably get that number lower. But you're paying multiple times sales basically to put in a line, and then you have the one publicly traded example of this business is trading at or almost half their sales in terms of EV. Cost of capital is very high. Times are good, and you have to put in new lines. It's a very expensive process. So these are big decisions. They throw off a lot of volume. They take a while to go from the investment to production. So during COVID, when there's a spike in demand for PPE and wipes and different disinfecting, all these things, a lot of companies made the decision, let's add capacity. And as that capacity goes from, there was stuff that was running over 100% utilization during COVID. So, normally like mid-cycle, these things are probably running somewhere between 75-85% utilized, because you got to keep some slack in there for maintenance and for kind of flexing when customers need their next order. But anything below that, and the margins start getting really tough, because again, you've got big facilities, big fixed costs. Anything higher than that is extremely profitable. So as these guys were making a lot of money in 2020, 2021, you kind of, you've obviously had demand spikes and drops over time, but there hasn't ever been like, oh man, we need 50% more diapers out of nowhere. Some of these are pretty steady end markets that haven't really experienced that kind of demand shock in the past. The capacities will ebb and flow. COVID was very unique in that a lot of these things were running over 100% utilization. Companies made decisions to add capacity, and too much got put in. And it has taken a long time to work through all that capacity in this market. Utilizations in 22, 23, 24 just kept dropping. And you ended up with, just a lot of levered private and, in this case, a couple small public ones like Glatfelter that really just had too much debt, had overpaid at the top, and now we're stuck with, hey, we still have growing end markets. These are products that are, generally GDP or GDP plus growing categories, but when you're running those at 60.
Yeah, so the oversupply here isn't so much that there's a bunch of product in a warehouse somewhere that's getting sold down. It's that there's all these facilities that are still running, and they're starting to run at more normalized number, let's say.
Yeah.
And we're getting to that. We're getting there is the underlying thesis. Is that correct?
Yeah, that's correct. And I think I hate to draw a comparison that's going to make people not want to buy a stock, but like you think about like oil rigs and how that's been over, like when you had like deep sea drilling and a lot of capacity that got built a decade ago, like you do that and then you have them and they're getting less utilized and they have high fixed costs. Like you can't just park one at the dock and leave it there for a while. Like you have a lot of ongoing maintenance whether or not you're using it. Otherwise, it's not going to be functional again the next time you need it. You need higher utilization.
Right.
And the capital costs up front are so high that companies are going to be very hesitant to then take those things out of, scrap them or otherwise take them out of the market because you had such a high upfront capital cost. Like there's huge sunk costs in these things. So if you just spent $300 or $400 million putting in a line, you're not going to be quick to mothball that thing just because the market's slowed down, utilization's bad. You're going to put your head down and say, like, my end markets are growing. I can stick this out for a few years and eventually the profitability will slowly come back. And you kind of get to the point where you knew nobody else was going to be adding capacity here for a while. So everyone's kind of trying to keep their head down and just know like, hey, if we stick it out, eventually there'll be enough to go around.
Got it. Yeah, okay. I think the next part is the sourcing. I mean, of the raw materials. There's a lot of talk about the polys. I think it'd be helpful for you to lay it out and we could riff on the questioning from there. I know that's like a big risk here. So it'd be helpful for you to kind of tease that out for us.
Yeah. So one of the things that the HHNS...
I should say risk, but I should also say synergies. I should also say synergy opportunity. So I want to make sure we're always painting these things in both slides. So yeah, I'll let you go both ways on that.
Yeah. No, the raw material cost is a huge component of the cost of production. So that's, that part is variable. One of the things that I like about this deal, one is for HHNS, the ag Glatfelter in, they have better buying power. They're going to be able to do this and negotiate these on a bigger scale. They're now the largest non-woven manufacturer in the world. So they get some scale advantages here, which in a competitive business like this with lower utilization, it's going to really help them to be able to negotiate better costs. One of the things that Glatfelter didn't do well was pass through their costs. So what you really want to be doing here is you're selling someone a wipe, and the cost of the wipe is materials plus cost of manufacture plus a reasonable margin. And when the margin is too low, is you have a hard time covering corporate fixed costs. When the margin is too high, your end markets get nervous and they're going to start trying to figure out how they can go find more capacity so that they don't end up paying you, because the consumer is not completely elastic on what they're paying. They're going to go to a lower cost product if you're overcharging. HHNS has been moving the Glatfelter business and already had most of their business on a very fixed key input cost models. I think the risk there with Glatfelter was a lot higher. I think as a combined business, they're making the right call of trying to not take the commodity price risk here. They're going to hedge their energy costs, which again, they were already doing it in the HHNS business. Glatfelter was letting those float a lot more. They're trying to come back in there and just be like, hey, we need to take a margin. We need to not be taking all these other risks that, we don't want to know if natural gas spiking in Europe is going to be good or bad for us. And we don't want to take that risk. We don't want to know if the poly inputs are going to go up or down and take a lot of pricing risk there. We want to tell Clorox, your wipe costs, fixed costs of what we had for the inputs plus a margin. And that contract is just going to, whatever it costs, that's what it costs. You guys are going to pay that plus the margin. So I think they're doing a good job of fixing those. And as a result, this is a business where, revenues can fly around because if your input costs are going up a lot, you could have your end markets, your customers are paying more to get your product, but it's not really like the margins aren't really going to scale. You should still see relatively fixed earnings growth. So as you're looking at it, like you can see revenues up or down 5 or 10%. And sometimes that's just inputs prices moving as opposed to actual volume differences. So I think that's certainly one thing to watch here and understand about the stock is you're not going to always see revenues be the most predictable or the most consistent, but the earnings growth is what they're really trying to fix that margin such that you can have relatively steady earnings growth in that department.
your revenue would just pass right through. I mean, that cost of goods sold would pass right through revenue. So revenue might go up 20%, but that's because you had a pass through on costs going
Yeah.
up 20%. But I mean, how much was that like a COVID phenomenon in terms of the ability to pass through costs, right? Because during that time, people wanted whatever they could get their hands on. You think that's
Yeah.
going to be in this next iteration of contract re-ups? You think that'll be a steady state phenomenon,
Y-
or do you think it's going to be
I
incumbent
think that's
on
where the world's
Blackstone
gone
or
with a lot of these types of production processes. I think that I mean the short answer is like you just have to go to these guys and look, be like, we can't take all this pricing risk for these inputs. It has to be hedged somewhere, and we have to have pass through in that regards. COVID and some of the supply chain stuff was so unique relative to how much some of these prices flew around that there were a lot of companies that previously didn't try to do this that are now realizing like, oh, we can't afford to take price risk. Again, Magnera is the largest player in this space, and I think they're kind of setting the terms on that more than you might think. Again, this is my
interesting?
calling around and trying to figure out how things were going during the contracting cycle this year. Got the impression that some of the bigger players are getting to the point where it's like, oh, like there's been all this slack capacity, and like Magnera announced they took 5% of theirs out. That's again one of the things we can get into here, but that they actually they did consolidate some space in a way that all of a sudden as people are calling them and starting to look around like, all right, where are we going to get our where are we going to get our wipes and diapers this year? They have less flexibility than they have in the last couple of years, and so I think that basically it's like, hey, either you want it or you don't, and you can try and go somewhere else, but it's going to be cost plus a margin, and that's the way we have to run this business. That's the right way to run this business, but we're not taking anything from you on the upside. Like if prices go down, we're not going to get a huge windfall. And if prices go up, then we're not going to get a huge windfall either. We're just going to keep producing your product at a good cost.
Yeah, yeah. Well, those are all, I guess, the reading the tea leaves in some sense of like where the capacity is going. I guess is always you can see it in those contract negotiations. Those are the boots on the ground. Those are the guys that have the real information that we're always trying to glean from. So it's interesting to hear that you've had those conversations with them. I did see that they did reduce capacity. I wanted to understand that a little bit and segue that into, I think, some divestitures that they may have had that generate some cash. Is there anything like that forthcoming as we think about this deleveraging process, or is that largely complete? So those were kind of getting. Maybe we'll kind
Yeah.
of transition to the capital cycle unless there's anything else to discuss on the operating side.
Yeah. There hasn't been much material on the divestiture side. I was kind of, I was hopeful that they would have a couple businesses they could sell off here to kind of put a mark on what some of this capacity is worth relative to where the stock trades. But the problem that they have is pretty industry wide, which is a lot of leverage and not a lot of cash flow. I think basically if you ask somebody here, like, hey, who would you sell these assets to? It's like nobody's a buyer right now. Like everybody's trying to pay down debt. Everybody's trying to delever. Nobody's in the market going like, hey, let's go buy some stuff. Let's lever up. So in Magnera's case, they at least have stock which they can use as a currency if they want to go do a deal, but they don't have much in the way of, I don't think there's any big private equity firms that are out there trying to consolidate the space right now. Might be interesting. And there's a couple on the shareholder register at Magnera, which is, I think, notable. But overall, there's really not a lot of buyers for this stuff right now. That for the most part, everyone's got their head down and they're just trying to pay down debt and get their balance sheets into a better place. So they could try and take stuff to market. They certainly could try to sell a division here or there, but I think overall they feel pretty good about their position. They think they can delever organically and grow earnings to the point where the leverage starts looking less scary.
So, David, kind of getting on the deleveraging story there, I think it's so important to the thesis. As I said earlier, in the pre thing we did, this seems to me you could argue this is like a publicly traded LBO. Where
Absolutely.
as they delever this thing, the financial, the bankruptcy risk, the financial risk of the company lessens. That should accrue to the equity value. And so when I think about that, obviously cash generation is very important. And part of the cash generation story is, one of these merger synergies, which what I've read, they're targeting around 55 million, I think, run rate synergies, by year. I'm not sure, maybe over 3 years or so. So they have $55 million synergy targets, and they've got this Project Core, CORE, which is stands for capacity optimization, resource efficiency. They're trying to, in addition to the synergies, get, I think, another 25 million, give or take, or 20 million maybe in annual cost savings. So add all that up, and they're trying to get 75 million of synergies and cost savings, which obviously would be a big part of driving that free cash flow generation. If we step back and say, okay, well, how realistic are those targets in your mind? I mean, given the nature of Berry's assets combined with Glatfelter.
Sure.
And so that's kind of like the first question. And, I'm a neophyte on these business, but my understanding is that Glatfelter really, what they brought to the table was an air-laid technology. Their air-laid assets are considered world-class, low cost, and what Berry brought to the table was spunbound. And so there's a unique combination there that I thought in my research, I was like, I like to take products apart, and nothing is more fun than taking apart a baby diaper. So here's a question for you. How many parts comprise a baby diaper? Do you know?
Only thanks to Jeff's hard work on this do I know the answer, and that is 12.
There are 12 parts to a baby diaper. That's correct. There's 12 parts to a baby diaper. Based on my research, 11 of those parts are made by a spunbound technology, right? That would be kind of the Berry. But the 12th, and arguably the most important part, which is the absorbent core, right? The stuff that lops up all that stuff we don't want, dripping down the baby, that comes from an air-laid technology, which is produced by the Glatfelter assets. They have world-class air-laid assets, from what I've read. So I guess putting those together and becoming a one-stop shop for a baby diaper value chain, what are the prospects there, kind of vis-a-vis this $55 million synergy target and the $20 million cost savings? Like, I could see how this could work. But what are the risks to it not working, and how important are realizing these synergies to generating the necessary, kind of unlevered free cash flow to delever this thing to the point where by the time we get to 2029, we're not taking on massive refinancing risk in the equity?
So I think it's one of the things that's in some ways both scary and the biggest opportunity is when you get into something like this, synergies. We've all seen, it's one of those things that gets thrown around a lot. Different companies achieve them in different ways, especially in the roll-up world. You often will hear, see big numbers thrown around. Oh, pro forma for this, this, and this. This is only 4 times levered. And then it's like, well, it's really 7. So, basically, can you get credit for that or not? Can you execute on it? So I think that the synergies here are achievable. I was able to go look at a couple precedent transactions, both kind of what Glatfelter had done with their acquisitions, and Mativ is one other publicly traded company that does some work in the nonwoven space. And, basically they came up with a pipeline of $120 million of opportunity. And they said, hey, we think we can achieve 55 million of this. And we're going to go after those. And so far they are, they are achieving those numbers. That's what's driving the earnings growth going into 26 is them capturing some of these synergy targets. And they walked through some of the different reasons for where that was happening. There was 10 million of G&A spend targeted. You have the back office overlap where, you don't need every single person from both companies' legacy G&A business. There was some kind of like very niche but meaningful savings on warehousing. Like H&F was doing, I think, less than 5 million a year in warehousing costs, and Glatfelter was like 15. So it's like you had a bigger business that was paying a third of the cost and it's like, all right, well, clearly something's inefficient here. Let's go after this and find out a way to consolidate our footprints in a way that we're doing this better and more efficiently. Again, some of this too was that like Glatfelter had worse supplier contract terms because their solvency was in doubt. So just by having a larger, more solvent corporation, like they've been able to slowly ease terms on the contracts and the way that Glatfelter was doing things that just were, their suppliers are demanding money up front in a way that, they weren't with HH&S because it was attached to this larger Berry mothership. So the way they've laid it out was, 55 million over 3 years. This is part of a much larger $120 million pipeline. So we're assuming less than half of these actually get achieved. And to date, they're tracking with those pretty well. So I think it's reasonable. I think, this isn't one of those deals where they're hitting you with like, they didn't hit you with a diaper revenue synergy number saying, hey, like we are going to cross sell all 12 pieces of the diaper together. And that's going to get, an extra 20 million of revenue, or we're dropping that down as a synergy. That piece is where more of the upside is, as opposed to what they're trying to bake in on the synergy side.
Well, what are combined sales roughly? A little over 3 billion, 3.2. Does that sound right?
Yeah, they finished 3 for 2025.
Okay. So that's less than that's less than 2% of combined sales, right? So that's not a massive stretch on the synergy basis, I wouldn't think. I mean, I don't know what's typical for the industry, but
I wasn't able to go through and find anything that felt unreasonable about what they were estimating, but
okay.
I appreciate the skepticism that usually comes when you start throwing the word synergy around on deals like this.
Yeah. Totally. Well, and then on the cost saving, that's kind of separate. I think, Donnie, you tapped into this. Part of that is just, kind of rationalizing capacity. How far into that are they, and are they tracking on that project core pretty well at this point in terms of realizing those savings?
Yes. That was kind of, they did I was close to a year after the merger closed. They announced this rationalization. It basically said, hey, we spent our time trying to get our hands around all the different businesses, where their strengths are, what our customers like, what they don't, where the opportunities are. They announced one plant closure in Argentina, which was one of their 5 in South America. And like, talking to management, they basically said, look, we figured out what we were doing at that plant that customers liked, and we figured out that we could move it to our 4 other plants and keep doing it and get rid of the stuff we didn't, and go from 5 to 4. So we can rationalize that plant, move the production to our 4 other locations that we want to keep, and get rid of the stuff we don't. And like, we've maintained all the business that we would have wanted to, and now just have a smaller fixed cost footprint. So a lot of this core stuff wasn't necessarily, like, it wasn't stuff that was initially captured in the synergies model. It wasn't initially captured in the merger, but it was like, hey, as we start doing this, as we go to customers, as we figure out, what they really want, where we can, where they're going to be able to cross sell, there's probably going to be some opportunities to combine footprints here. And yeah, if we have capacity at our 4 other plants in South America and we can move what we like into them, no brainer, as we figure out, what's the right size for our global sales team, who, there's going to be guys that, they've let go a few VPs and things. There's been 8Ks throughout the last year where they're just like, hey, we had some guys that, we figured out this, this role probably made sense at Glatfelter, doesn't make sense at, in the combined Magnera company. So, we can consolidate that role into something else or get rid of that team. And that's not, again, stuff that wasn't in the initial synergy kind of back office stuff. It's more just like, hey, how are we running the business? Does what is in place make sense for Magnera, or did it just make sense for HH&S or for Glatfelter?
Yeah.
So core was kind of that first real stab at, hey, we've looked at how the business has been running for a year. We've gotten a better handle around some things, and there's $25 million of costs that we can probably take out, and the cost to achieve that is going to be less than a year, and that's all baked into kind of where this business is going with guidance, and where how they think they can run it better than it was being run.
I think that's helpful. I mean, sometimes these soft periods allow management to rationalize quicker, faster, further, right, than they would have otherwise, because everyone comes in with a great hope in these kind of new entities. It would be helpful to understand, I mean, to achieve these cost synergies, to execute what they really need to. I mean, it's kind of, maybe it's not walking a tightrope, but it's tight over the next 5 years, given the leverage. What is your take on management, and how should we be thinking about them, and maybe some primary work you've done, anything that you can to kind of, I guess, understand if they are the guys to execute going forward?
Yeah. Well, I certainly was more interested in the combined company because it was the HH&F team that was taking over to run it. So Kurt Begley, the CEO, and James Till, the CFO, talked to them a few times. I really like them. I think they are very clear-eyed about the business's potential. Kurt's been in the open market buying stock on and off throughout the last year. He already has a comp package that's like 75% at risk, and all of the targets are related to business performance with EBITDA, stock performance. He already has an incentive package that is very, very well aligned with shareholders, and he still believes in this thing. I made a comment to him when we caught up after their Q4 release about how it's like, I'm sure things aren't quite where you thought they would be when you bought stock at, $22 back in February. And he says, well, when I bought stock at $22 in February, I wasn't thinking about where we were going to be in 9 months. And I really like that mindset and how they're trying to run this thing. They don't really care about, where the stock is going in the short term. They're focused on trying to run this business well. When I was looking into the merger, there was actually an expert call out on Tigas or AlphaSense. It's all one platform now, right?
Yeah.
Basically, that was with a former chief marketing officer at Berry, and was talking about the Berry business. And he made a passing comment about how sad they were that the HH&F team was going with this merger, because they were solid guys and like were up and coming leaders in Berry, and like it was a loss for Berry. It wasn't an expert call about Magnera. It's not out there for Like this guy wasn't
Yeah.
being questioned, trying to get him to say like, hey, these are good guys. Just like volunteered, like that's a really good team that's going with that business. So there's some stuff out there that suggests that Berry knew what they had here and they really like these guys. And I like the setup of a good management team going to a business that's been capital constrained, finally getting an opportunity to really get their comp completely tied to what they're doing and not just being one unit inside of a much bigger conglomerate. So I think there's, I think if you read through the proxy, I think if you look at these guys, you'll see that their comp is well aligned and that they've been, a lot of board members have been buying in the open market too. I think there's just a lot of people here that really believe that what they have is worth a lot more than where this thing is currently trading, and that they think they can really dominate this market for a while here. So,
David,
yeah.
and Donnie, if you want to follow up on that, I'll shut up and let you keep following up. I was
No, I think, I mean, I wanted to get into I just want to get into the setup now. I mean, I think,
yeah, that's what I was thinking.
where you think we can go and understanding, the key players in in this setup, but maybe I'll just leave it broad to start. Like, it's today it's trading at your version of, what's your evaluation? Well, I'll leave it to you to walk us through that rather than what we kind of have seen out there. But it'll be helpful to understand that, and we can take it from there.
Yes. What's the right multiple put on this business is a complicated question, because the first question you're asking is what's the right earnings number to put it on.
Yeah, correct. Very good. Yeah.
Fiscal 25, they reported $5 million of operating income unadjusted. So, the multiple on that is rather high. And there's 200 million of DNA in there. They ran through almost $100 million of synergy achievement costs, transaction related expenses, all the usual noise that you see from doing one of these deals. So you can get yourself back to around a 300 million EBITDA number from that pretty quick. There's also some non-cash stuff like stock comp that's in there. And then the leverage number they report, they also add in full synergy achievement to that number. I think
of course they do.
The FY25 final pro forma adjusted EBITDA number they're putting out there is $430 million. The adjusted EBITDA number that they're guiding to was $354 million, and that's the pre-synergy and pre some noise with how they did the merger during the very beginning of the fiscal year. So you can make an argument for anything from around $300 million to $430, depending on how they're reporting it and how you want to look at, how much noise you want to adjust in or out of this business. Do you like stock comp? Do you not? There's a $4 million adjustment for Argentina hyperinflation, which they don't have any business in Argentina anymore. All right, that one's gone. So there's some little things in there. I know it's a below. There's not a lot of adjustments. It's exactly what you would expect from two large businesses that got mashed together and are working through a lot of costs associated with that. So what I did appreciate is that despite all that, they generated over $120 million of cash flow during the year. Again, some of that is stuff like working capital and getting better terms. Some of that is just operating the business as well. But the free cash flow number isn't being like adjusted for, hey, ignore all this money that we paid to people. Like we actually had negative cash flow. Like, no, they are paying down debt. They're reducing leverage in the absolute sense. And they've got to do another $100 million of cash flow in this upcoming year. Again, it sounds like a step down. Some of that is, again, working capital and timing things. I think some of that's conservatism. But this is still a cash generative business. They are generating EBITDA. There's just also a tremendous amount of noise from the merger. So I look at it kind of just on a pro forma basis. I'm looking at it kind of around a 400 million EBITDA number, looking at 26. They've guided to a range between about 385 and 405. That guidance assumes no real mitigation of the pressures they've had in South America. That guidance assumes no increase in volumes in Europe and North America. It doesn't really assume, it assumes the timing of the synergy and core capture kind of ratably throughout the year. That's not a number that's saying like, hey, we're going to, add back all of the synergies and stuff we're working on throughout the year. If there's a 20 million cost savings that they achieve halfway through the year, then there's 10 million in the guidance. So I think 400 million is about the right number for this business right now. That puts them around 4 times levered on about 1.6 billion of debt, or net debt. So yeah, it's pretty highly leveraged. If you look at it kind of on a retrospective basis, they're closer to 5 times levered. So there's a lot of leverage in here. I think that they can continue to capture these synergies and get that number above 400 in FY27 without, again, any meaningful volume or recovery in that regard. But I also think that as we enter into 27, that's where you really start seeing the opportunity that, some of these utilization numbers can start coming up. So the world can grow back into the capacity that exists. And there's absolutely nothing out there that's new capacity coming into these markets. So I think that's kind of where the juice will be. I think this can be like a 500 million-ish EBITDA business as they get to more mid-cycle in 27 or 28. I think they can be generating, north of 100 million of cash flow at that point. And, then all of a sudden you might be looking at starting to have to refi the debt here, 2-3 years from now with 500 million EBITDA, 1.2, 1.3 billion of net debt. That's a much less scary place to be for this business than, being 5 times levered or whatever they were at the beginning of this year.
And on
One of
the
the numbers
debt,
of the EBITDA, just real quick, Jeff, because just talking about the kind of the operating element of this is the your EBITDA. I tend to think of as a good proxy when I think of capital light businesses, but this is the fairly capital intensive business, I guess. So when you think about the capex cycle here, how should investors think about that? Do you think there's going to be a large reinvestment, whether it's maintenance or expansion capex?
Yeah, eventually, yes. With the merger, they kind of guided to, I think it was around 3% of sales for capex in the short term, and then said medium to long term, this business probably goes up closer to 4 or 5. So that's certainly, it's a problem I'm ready to have, because when capex grows, it's because they need to start adding more capacity. And if we're adding capacity, then things are good, and things aren't good. So I would love for things to get good. And I think the capital intensity of it will be more than offset by the increase in EBITDA at that point. So again, D&A for the last fiscal year was about $200 million. CapEx guided for the upcoming year is a little bit under 100 million. So they're certainly investing at a lower rate than that would imply previously. Although again, I would caution that there's some amortizations in there from them overpaying for Jacob Holm and stuff in the legacy Glatfelter business, while they're amortizing some of that stuff off. It's not so much capex as just bad capital allocation. So I think the real number for this business, capex wise, is probably going to level out to be around $150 million a couple of years out from now. But if EBITDA is $350-400 million now, and it's going to be 500 at the point where that number starts coming back up, but we're going to be more than fine, especially as interest expense comes down as they delever here on their more expensive debt. So yes, it's I think it's pretty obvious that they are underinvesting relative to run rate D&A here, and that's because they're over capacity, and there's no capex you really want to go do on the growth side right now. It's just taking care of your machines, replacing stuff as it breaks, and keeping your head down, paying down your debt.
Yeah, that makes a lot of sense. Jeff, you want to swing on to the debt?
Yeah, so on the debt, so it looks like, you've got primarily 3 kind of tranches here. You have a term loan, clean term loan. I think that's like around 780 million change. I think that's got a maturity of 2031. You got 7.25% first priority senior secured, also doing 31. And then you've got these 4.75% first priority senior secured notes due in 29. That's the nearest maturity. My understanding is all these are senior and pari passu, which we're not making a debt play here, but I find that interesting. They're 2 of these, the 475 and the 725 secured notes are publicly traded. I'm pulling them up on Bloomberg. There's no distress there. These traded. I'd have to go actually look here in a second, but there's, I think they traded something like, between 90 and 95 cents, or 90 to 95% of par. What is as they're delevering, what are they delevering right now? Do you know, are they paying, I would assume they're paying down the most expensive stuff, which I think would be would that be the 7.25%? I think the term loan okay. So that's SOFR plus you get a 4.25% margin on the term loan.
The term loan is
what they're focused on now
is 9%.
Okay, right now. So they're paying that down actively at the moment.
Yep. And that was one of the questions that came up on their call. You mentioned, like, you look on Bloomberg, debt doesn't trade like it's in distress. There was a window in the October-November timeframe where the debt did start to trade down and was briefly trading at like an 11-12% yield. And it was one of those times where, I was getting inbounds like, hey, what's happening? What broke? The answer was nothing. All that happened was the stock was drifting down. Some people were saying that it was basically that there were debt holders that were getting nervous because the stock was getting lower, who were shorting it to try and hedge their debt position. Ultimately what happens, sometimes just people start panicking because they think someone else is panicking. Whatever happened, the debt started to decouple a little bit and start trading down. And there was this kind of like, hey, what's going on? The stock's trading off. And then they came out in November and it was like, hey, everything's fine. There was actually one bank that stepped in and upgraded the debt a couple of days before earnings. It basically said like, hey, I don't really know why this is trading at a double-digit yield. They're fine. You can buy this debt at, 80, 85 cents on the dollar, and you're gonna be okay.
I'm looking here. It traded down. I'm looking at the 4.25% notes. Traded down to 82, give or take 82.
Yeah, there was a brief moment of panic end of last year. That's right around the same time the stock was $8, and then they came out and reported and were like, "Hey, don't really know what you guys were all doing, but we're fine," and everything's traded back up off of that. So I think they have very little in the way of covenants here,
right?
So the debt lets them do almost anything as long as they keep paying it. If it's if your question is, hey, how high does EBITDA need to stay before they trip a covenant? There's nothing. If it were to go to 200
there are no maintenance. I would assume there's no maintenance covenants. There might be some incurrence or something.
There's a couple. There's a couple of really light, I forget exactly what's in there, but basically in terms of earnings
I think
power,
I saw there's a springing fixed charge coverage ratio that might come into play if the ABL capacity drops below a certain level or so. I don't know. It wasn't enough when I was looking at it to really worry me.
Yeah. What's your take on that? Look, I think about these highly levered companies. Usually the covenants are pretty tight, but here, I mean, they're very loose, and it's really a time where we're all covenant-light deals. I mean, maybe it is. Maybe I'm mistaken on that. But what's your read through on that? And then just to I think a follow on to that one is how active is this creditor group? Are these people, I mean, do you know anything about them? Are they writing letters occasionally or banding together or anything like that? Is there anything that goes on behind the scenes with them? Or is this sort of, your typical bond funds that want to get a nice coupon that are holding on to this?
And as a follow-on to that, as a follow-on to that, just because I think this would be a good time to bring it up. I mean, when I look at the ownership structure, I think 9% of this thing is owned by Littlejohn. It's a private equity firm. I don't know a lot about them other than I know they have a reputation of being very active in complex distress type of situations. From what that's what I've heard through the grapevine. Complexity distress, right? And so I know they own 9% of the equity. Is there any chance that they also have a position in some of this debt? Is there a play there maybe that we're missing, or do you have any way of knowing?
I don't know if they own the debt. I have not talked to them, so I don't have a really good angle on what they're doing. You go look at their past portfolio companies. They've got a pretty good track record. They were former owners of business I actually just made a lot of money off of, Clean Earth, that got sold by Enviri last year. They seem like pretty sharp guys. I think they know this space well enough to understand that these assets are worth more than where they're trading, and so I think that was why they came in here and built a stake. But again, I don't have any real special insight into their position.
Now, my understanding is they're very sharp guys. Anytime somebody's in the capital structure with me that's very sharp, I always worry a little. You know what I mean? Especially when there's a lot of debt involved. And they could be across. They potentially. I have no idea of knowing, but they could be in multiple parts of the capital structure. So I don't know if there's anything to think about or to worry about. But
I've taken a slightly more constructive view that post reverse Morris Trust, there's a 2-year window where the tax benefits you got from doing the reverse Morris Trust will be undone if the company sells itself. So there's a bit of a clock that came with this deal that was, hey, nobody is going to buy this thing out in the short term. I think it's notable that if you go look at the cap table and you've got Littlejohn in there, you got Madison Avenue, you got Engine Capital, you've got Ancora.
Yeah, Engine, I saw Engine in there,
Yeah. For a 500 million market cap company, I usually don't find that kind of roster. Michael Burry bought this thing on the spin at one point. The number of people that were in here when it first came out, I was like, oh, wow, there's a lot of people looking at this thing. There's a lot of big holders. Close to half of the stock is sitting with, some of these bigger names.
Right.
Yeah. So on one hand, like you're saying, spooky if things start going sideways, because some of those guys are going to be ruthless about cutting exposure if they need to and things aren't going well. So I don't want to act like, you watch how the stock traded during 2025, there was a hedge fund hotel aspect to it in terms of how the business was performing and how fast things would go down.
Would you consider pairing an equity position by owning some debt? I mean, is that a sensible trade maybe?
I mean, I think you could do worse. I think the debt, again, other than that window where it briefly traded, there was maybe some distress going on, I think it's a pretty safe piece of paper. I still feel pretty comfortable in the equity. If anyone wants to go out and do a pair trade here, I don't have a problem with that. But I think, one of the comments that got made by Kurt when he was at Wells Fargo last year, which again, I'm going to draw another comparison to offshore drillers here, so this is going to get me in trouble. But the replacement cost of these assets, from Kurt's perspective, is north of $12 billion. Replacement cost is one of those things. It's like, great, well, what are they actually generating right now? And the answer is about 400 million EBITDA. It's like, all right, well, nobody's going to go build that for $12 billion. So, and he's like, yes, that's true, but there's a big gap between that number and less than $2 billion of debt that's sitting on it, where it's like, look, what is, if you think about it from a, I'm creating this company around, 4 to 5 times leverage. Yes, there's certainly some concern that if earnings were to dip here or they'd have some issues that, the equity could end up being in a precarious, but I think these assets are, relatively immune from any kind of major disruption that's going to cause them to be permanently impaired. Diapers, wipes, all these end markets.
So let's
go ahead.
Right. Well, and if you've got, I was going to say, if you've got, I don't know if that number's right, but let's say theoretically it's roughly right. There's 12 billion in replacement costs, and these earnings have asset support. You would expect capacity to come out of the industry to the point at which the earning power was reflective of the replacement cost, right? And you've got an enterprise value right now of a little over 2.2 billion. So I can see why it's an attractive asset. I think if I had to push back at all, it would be anytime when I've done things like this and lost, there was some unforeseen event in the end markets, overcapacity, maybe a macro event that basically, when you have that much debt sitting on top of your equity, that when any kind of unforeseen thing happens, the margin of error is just so much less, right? And if you got to a point where we got close to 2029, or I think it's whenever that debt is due, and refi, they were not able to delever enough. So maybe they're trying to get to 3 times net leverage and they only get to 4. And whatever happens in that year, it's not a great environment in terms of credit and liquidity, and they can't refi, and then you just get fucked. Pardon my language. Can we say the F word on this podcast, Donnie?
I don't know. We might get flagged, but
we could bleep that.
We'll edit it out.
Apologies in advance. Only died in the wool value investors speak like that because of experiences we've gone through. So I guess what would keep you up at night? Like, look, here's something I just can't underwrite to in terms of risk with the equity. And sometimes for me, it's like, look, I can't underwrite it. It's a risk, but that's why the upside exists, right? So there is that point where you're like, look, I don't want to say, Jesus take the wheel, but that's a risk, right?
Yeah.
Yes, if something goes wrong between now and then, the equity could get in a lot of trouble, but that's why you have the upside. And so then, you kind of deal with that risk just by position sizing it correctly. I don't know how you think about those factors.
So again, speaking as somebody who has gotten involved in situations like this and gotten hurt, the fact that the end markets are all not in terminal decline is a really big boost here.
Right.
We are selling into markets that are growing. Some of them are growing faster than others. Obviously, like baby diapers brought up earlier, like baby's not a really exciting category. Birth rates have generally been on the decline. I don't want to try and tell you that that's something that, is going to start growing at a high rate, and like diapers is like a great place to be.
But adult incontinence, baby boomers getting older, that's interesting, right?
Diapers for not babies. Yeah, that's a different story. So I think that, I think there are some interesting stories in here. Like there, you have stuff too where like, you have an end market where you're doing like house wraps, and like anything housing related has not been a good place to be for the last few years. Like, I don't think that means that house wraps are in terminal decline. I don't think, but like you have end markets that have been struggling, and there's some of that can be, somewhat temporary, but it can look bad in the short term. But I don't think any of these places where they are selling stuff is of great concern about terminal value. They aren't selling into markets. It's like, hey, is this still going to be necessary if AI takes over the world? It's like, well, not more than any other consumer staples business. I think that a lot of the scary things that could happen here help get offset by, these aren't super exciting end markets, but they are still secular growers, and that is going to help reduce the risk that you get to a point 3 or 4 years from now where they're trying to roll debt and things are really bad.
Right.
Again, you already have a pretty stressed industry. So I don't think that a lot of the other players out here can really take much in the terms of more stress. Magnera, again, not having a lot of covenants, having termed out debt. I think they're in a stronger financial position than most of their competitors. I will have a really hard time proving that to you because most of them are private. But I think if you were to do some calls and look around at where a lot of their competitors are sitting, none of them are having a great time. None of them have a lot of cash. None of them are able to take price reductions in a way that they're able to keep running their business. They also have valuable assets, and they don't want to just close down and not use anymore. The capacity constraint has been cutting both ways, where like everyone's really just trying to stick it out and get the market to grow back to them. But I
Is
just
there
don't
any
think
risk?
go ahead.
So, oh, sorry, I didn't mean to cut you off. Is there any risk, and this has happened to me too, where you've got a balance sheet that's starting to right size itself through deleveraging, and because there are, there's all the other players in the industry are somewhat stressed, that the management decides to take another risk in terms of relevering it and doing an acquisition. And maybe we get a couple of years in and things are looking good, and then they take another big swing that may or may not work out. I mean, do you have a sense that is this management team capable of that, or do you think they're disciplined enough where they're going to be like, look, we're going to delever this thing to where it needs to be, full stop, and
Yeah.
not take any more balance sheet risk until that time?
Yeah. I mean, if you try to get them to talk about anything and they just talk about deleveraging. So, there's always a risk that levered cyclical companies make a bad deal. I don't think you can get away from that here. I don't think you can get away from that with any of these. I think that they very much recognize the existential risk with the debt, and you've got enough Glatfelter people around that recognize that, like, hey, look, basically, like, we ruined our business by getting too aggressive. I think they're going to want to use equity, and I don't think they can really use equity here to go buy something because it wouldn't make sense with the multiple they would go get.
Right.
Again, for a company that was trading with distressed debt before their Q4 earnings call, if you go listen to what Kurt said on the call, he said, look, we're taking market share in all the markets where we want to take share. And that's a comment where it's like, he doesn't really think they need to buy a whole lot right now because they're at least in a financially solvent enough position that they can go do stuff that their competitors are somewhat capital constrained on, and they can take share. And he feels that as they reposition themselves that way, as these markets come back, you're going to find out that like these businesses are better than they were because they've been repositioning themselves and they had the flexibility to do that while some of their competitors are just trying to stay alive. Again, They can grow when you have $50 to $75 million of synergies and cost takeout that you're doing. You're expanding your earnings power by a significant margin while a lot of your competitors don't have those same levers to pull without just shutting down part of their business. So these guys are also getting the opportunity to grow earnings, generate cash, and do things at a higher level where I don't think anyone else in the industry really has those same levers to pull. So again, I think that they are competitively advantaged in that way right now. And I can see why at first glance, someone will look at this company and be like, this is not really, like, this doesn't look like somebody who's competitively advantaged in the space. But again, that's my perspective. I'm okay with people disagreeing on that. But my impression is that as bad as things might look as you look at this balance sheet, like, this is about as good as it gets right now.
Right.
Yeah.
Well, and when the management team has had, or not this management team, but people in the Glatfelter part of the organization have experienced what over leveraging, taking big bets can do, you would hope that would instill a little bit of, of discipline and a little bit of humility, I guess, for lack of a better word, in terms of how we allocate capital. But Donnie, I've got all my questions out, I think.
Yeah, I think we got our questions. I think, I like to just think of these kind of the questions that maybe a little bit of orthogonal in some sense. But the stock drew down quite a bit, 21-8, I think. It sounds like, you were asking questions about this, seems like a year ago or so. It's a market where it didn't draw down, it wasn't like a tariff tantrum. It was way late into the year. How'd you keep your wits about you? You keep level headed about things. I mean, that seems like when everything was just kind of a go up environment, you seem to be very level about it, and I applaud that. Any words of wisdom through that you could give would be helpful. I'd love to hear that.
It was not a fun stock to own last year. I'll give you that. It was fun for a couple of days in November, but most of the other days it was not. It was fun in February. There was two very small windows last year where I was having a good time with this guy. It's funny you say that because this is why I don't own one stock. This is why I have a portfolio. Writing this thing down was an absolute grind, and I really hope to not repeat that. And I really try to avoid being early on something like this. I think with stocks like this, the question that as they're going down and they're just grinding lower throughout a long time frame is I keep going back to, like, am I missing something? What is out there? What information does someone else who's selling this to me at $8 have that I don't? And just trying to make sure, hey, I get stuff wrong. I've made bad investments. I have lost lots of money at various points. By and large, if my work is good, usually the things turn around. And I think here it's good. I thought that the most recent report was a sign that, like, hey, all is not lost. The debt does not need to be trading at 82 cents. Everyone took a big sigh of relief, and that was good for like almost an instant double on the stock. Do I still own it because I think it can be a $50 to $70 stock a couple of years from now? Absolutely. right now it's a $15 stock. And I think that that's a whole lot more fun than 8. And I still think that's the opportunity. And the question just becomes, can they delever and grow the earnings fast enough that the solvency and the terminal value of the company starts being less in question, and it starts becoming like, hey, well, this isn't a great business, but it's an okay business that's trading at a trough multiple on trough earnings. And if that's the case and they're not going out of business, then this price doesn't make a whole lot of sense. There was, again, talking about comparable sales in the space is tough because a lot of those comparable sales are businesses bought by someone like Glatfelter. So I'm hesitant to go out and say like, hey, use this comp for this really bad deal we did 3 years ago. That's what you should be thinking about, how like what this is worth. But if you go look at Berry sold their tapes business as they were getting ready to spin this thing off for 10 times EBITDA. And like this business is trading somewhere, again, depending on how much you want to adjust back into here, if we're around 400 million EBITDA and 1.6 billion of net debt, we're at 4 times leverage and about 1 turn of leverage in the stock. So we're at 5 to 6, depending on how you want to, play with the numbers, maybe a little above 6 if you're not making a lot of adjustments. 10x is, over $1 billion of market cap that we don't currently have on a 500 million market cap. Like that, that's a triple. So again, public LBO, like you said earlier, Jeff, ton of torque, cuts you both ways, but there are a lot of comps out here that most businesses in this space would trade in the high single digits, low double digits. I'm not sure the diapers business is worth that, so you gotta make some adjustments here. I think tapes was probably a better business overall, but I don't think it should trade at 5. And if they delever a couple more times, and this is a 500 million EBITDA business with 1.2 billion of debt in 3 years, and it's trading at 2 times. Well, how much leverage should be in the equity at that point? Even if it's 3, that's a triple. 6 or 8, we're getting into crazy land. Again, end market's growing. I feel like that's a bet that I want to take. As hard as it was to watch the stock be terrible for most of 2025, my general impression was these guys are doing what they need to do and they're executing. Very little of this has to do with anything they can control or they're doing wrong. If China's going to flood.
I often think about, if we were like, in some of these stocks that we all have owned in the small cap land, and if it was just you and I owning this stock, we probably would have not even thought twice about calling these guys up. And like, what's going on? What's going on? We would just say, hey, keep executing day by day. Yeah, there's this one short-term phenomenon, but we would go and hit golf balls and tell these guys to keep working hard. But in the public market, you get these marks, and you have to really live with them. Maybe the private equity fund that held this, I don't know. Did they mark to market, or do they use the valuation from the third parties? I don't know. And maybe it's a question for another time. But this has been great. I really appreciate the deep work you always do. You always bring it, David. Every time you presented something, I hear you. You always bring it. Anyone wants to find you, where should they find you out in the world?
So kingdomcapitaladvisors.com. We have all our letters are up there. That's our fun website. I'm on Twitter quite a bit at KingdomCapADV. So I like to talk about a lot of ideas on there. So if you want to go read through my last year of tweets about Magnera, you can kind of follow the sentiment the whole way down and back up here. So that's all out there in the paid record.
That's great.
It's in my letters talking about how I don't think things are as bad as they're going to be. And then the next letter is like, well, they've gotten worse, but I still feel okay about this.
That's one thing. So I don't run an outside fund anymore. That's one thing I don't miss is the letters, having to write those letters. It's like, it's gotten worse than we thought. That's never a fun thing, but hey, that's the reason a lot of people don't want to own stuff like this, right? Especially if you have outside capital where, you have to explain, every quarter. If you're writing quarterly letters, you have to explain it. That's the opportunity too, right? I mean, it's easy to own Mag 7 when Mag 7's going up. It's not easy to own something like this that's going down when Mag 7's going up. I mean, that's like a double whammy. Not only are you not keeping up with Mag 7, I mean, if this one part of your portfolio is underperforming, is falling when the broader part of the market's going up, that's tough to hold stuff like that. And I think that's why the opportunity exists. But what I like about this idea is that there's some very measurable things you can watch, you can follow. The levers that need to be pulled, or I should say the things that need to happen to have it work out are things that you can track in real time. And my last question is like, what would make you pause if something happened? What would make you reconsider the position? And that'll be my last question because I know we're running out of time. But like that's something I was like, okay, if this happens, man, I might have the position. Is there anything that would really give you pause if you found out or saw?
If a major player in nonwovens announced a lot of capital investments in the U.S. and said, hey, we are going to go build a whole lot more capacity, that's just going to ruin everybody's day.
Yeah.
I imagine if there was a major announcement of that type, the stock would get hammered, and it would be deserved because you would take a story that's supposed to be inflecting in the next 12 to 18 months and push it out.
Yeah.
You can't make these
Yeah,
end markets grow.
And now you have the 2029 refinancing now all of a sudden is an issue, right?
Yeah.
Yeah.
I don't know of anybody that wants to go light money on fire like that right now. So like, I think we're okay. That would certainly be major capital investments get announced. That's going to be tough to stick around here and watch this whole cycle continue. I think one other one that is at least worth highlighting. They put out a press release in October, November about basically the first, like, developing a PFAS free gown for medical workers.
Yeah.
Or at least no added PFAS, I think was the phrase they used. So it sounds like there's still some in there, but there's litigation going on about PFAS. That's, one of those areas that is still kind of people trying to figure out what that's going to look like. I mean, they're saying, hey, we've got the first one that doesn't have added PFAS. I presume like everybody that's doing this has an issue. Right. The litigation that's happened around that so far has been going past them and towards end customers like the 3Ms of the world, or like what's the new one that just came public? Meta, the huge.
At the end of last year.
Just IPO.
Yeah, Donnie, you mentioned it actually. I think
Meta Advantage or something like that. Or
I can't remember.
I'm blanking on this right now. I should know this.
Yeah, I'm probably blanking on that.
It's an end customer of
comments.
Magnera's that does medical equipment distribution. Most of the litigation around that stuff has been going to those guys and not to the Magneras of the world. If they got named in a lot of lawsuits, and if there ends up being a lot of PFAS payouts because courts determine that
this is lawsuits for having PFAS in
your products.
That's when they make repellent materials, right? That you get, there's a safe way to do it and a non-safe way. And these PFAS, real quick, what's PFAS? I mean, it's shit you don't want in the garment that's bad for you.
It's like the microplastics of the world that, we already had it all throughout ours, but we're still going to be litigating this for a while.
Right.
I don't have a strong view on where all that's going to go. I don't have a strong view on what their exposure is. Again, they don't have any major disclosed stuff around this yet, but like, if you came back to me in 3 years and said, hey, this went to zero, what do you think happened? That would probably be my first guess, is that something with PFAS came out and it was like existential to the company. I'm not really sure what they're supposed to do about it. Go ahead.
Don't they have a PFAS-free solution? That's kind of one of the growth opportunities.
When they put out that release, that was kind of the implication of like, hey, everything we've sold up to this point was not PFAS-free. And so this is like, hey, we now have one offering. So I think that's the, you kind of are painting a big target there that says like, hey, everything before this one had it. And I don't know if that litigation can really be said like, hey, you guys were doing this and you knew it was going to cause consumer harm, or it's like, well, there wasn't a solution and we developed one and now we're going to move away from it. Do you want us to just not make medical gowns because they were needed and someone had to produce them and everyone was making them with these things on it because that's what we use as repellents?
Yeah, right.
Again, my perspective is that them being sued and having to make large payouts because they were working with the best technology they had at the time seems unfair. Litigation is not always fair. But if I was trying to come up with like an existential thing that could happen, that was probably where I would focus my time and attention to try and quantify that angle. Again, that's why I don't own one stock. So if you're looking for
some of these risks,
risk, that's
weird way to, there's risks with everything, but look, you've thought of them, you've thought through it, and that's good because there's nothing in life that's certain. There are always ways that these things can go the other way, and I mean, at least being cognizant of them, I think, gives us the ability to manage that risk a little better. And what I always come back to is position sizing. Is your point? That's why I don't only own one stock. There's some things you just, that's just the risk you take. But look, David. Dude, it's been great talking for the last hour and 21 minutes about Magnera. And dude, thanks for coming on the podcast, for all the diligent work you've done on it. And looking forward to seeing you in May, Value Seville. We're going to have another great event this year. And look forward to seeing what interesting ideas you're pitching. And next time we see you, we'll grab a beer at the bar and catch up, buddy.
Sounds good. Looking forward to it, guys. Thanks for having me on.
All right. Well, thanks everybody for tuning in.